Welcome to a discussion about the outlook for equities in 2026. I'm joined by my superb panel to discuss whether we will see a long-term rebalancing of US and non-US global equities in portfolios and what that might look like. For the last decade, US equities have obviously dominated global returns. Are we finally at an inflection point where we could see other geographies challenging that leadership? And is this about valuations catching up, fundamentals changing, or perhaps both? So to unpack this, I have with me Gervais Williams, the Chair of Equities for Premier Miton, Matthew Beesley, the CEO of Jupiter Asset Management, Jeremy Taylor, the CEO of Lazard Asset Management Limited, and Helen, Jewell, the International CIO for Fundamental Equities at BlackRock. Welcome, thank you all for being here. So where I wanted to start by was referencing our Investor Pulse research, which Andy will have referenced on the previous panel, 300 investors, 150 in the US, 150 in Europe. And when asked what the strongest performing equity market would be in 2026, opinion was broadly divided across developed markets, with Europe leading the charge, closely followed by the US, and just behind that, the UK. So what I wanted to ask each of you is where you see the most compelling opportunities in a geographical sense, and if there are any particular themes or sectors that's driving that interest. Gervais, let's start with you.
Yes, I mean, actually, I'm a UK investor, so obviously you may feel I'm biased in this, but the bottom line is when I was last here, I said that UK equities were set to outperform, and despite the Calistone data, which actually has been pretty negative over the year, and the Bank of America survey recently, which said the one thing that global investors are certain about is they hate energy stocks with a passion, and they hate UK stocks just a little bit worse. So coming back to it, the position is that actually we've had streaming flows out of the UK market, and yet it's one of the best performing markets in the world, right? You know, if we just get a slight change in behaviour, it's going to be good. So coming back to your specific question, yes, I mean, we're moving from globalisation to nationalism. It's going to lead to all sorts of uncertainties. We're in a market which is, pretty much priced to perfection. The UK actually has a lot of income stocks and capital-intensive stocks. My expectation is, come the next downturn, is it next year or some other time, don't know when, then actually companies with strong balance sheets, companies with surplus cash won't just survive, they'll take over companies which have gone bust and accelerate earnings. I'm expecting the UK market to outperform not just because it's cheap, but actually because it starts to accelerate earnings versus most global markets, including the US. So yes, absolutely, I'm red hot. I'm very, very bullish for the UK. And that's nothing to do with the economy or the government.
Matt.
How do I follow that? Well, look, I mean, maybe for me it's pretty simple as maybe it's ABA, anything but America, I think. And look, I think there's a few reasons why not. First of all, I think next year is likely to be a year where relative returns matter a lot more than absolute returns. So I think there is a relativity argument here which probably trumps everything. When it comes to ABA, well, actually, I do lean towards Europe. I think Europe is interesting. Europe's interesting from a delta perspective in terms of earnings growth that we're going to be seeing in 2026 versus 25. Look, let's be clear, the markets have started to recognise a bit of that as well in terms of how European equity markets have behaved this year. So I think that's one important differential. I struggle to see the growth accelerating in the US from here, whereas I see upside risk in Europe, albeit on the previous panel, concerns around Chinese manufacturing, what that does to European growth, I think are very relevant. We heard about monetary policy, again, supportive in Europe. But I think a crucial point here, and this is then when valuation when relativity becomes important, is valuation. Today we sit at a position where US equity markets are broadly at about the 90th percentile of their valuation relative to history. So they're almost as expensive as they've ever been, and maybe with good reason. However, if there's downside risk to those earnings, or at least no upside risk to those earnings, and you look at where Europe starts, and Europe is broadly around 45 to 50th percentile relative to its history, and you believe there might be some upside risk there, and margins are lower, and returns are lower, so the opportunity for some cyclical growth to drive those higher, I think you could find on a relative basis, albeit hard to judge absolutely, Europe becomes quite interesting.
You're going to end up with a big consensus across the panel here, so I'm going to have to be slightly careful. Let's just put some numbers on this for a moment. You're going to get the research analyst view from me. So if you start off by looking at return on capital across the globe, you're absolutely right. The US market is the most financially productive, but it's only 35% more productive than Europe, but you're paying 60% more for it. So you've got to really understand that trade-off. And then looking forwards, you've got to think a lot about where incremental returns are going to improve versus potentially deteriorate. And AI is a big theme everyone's spoken about all morning and will continue to talk about all next year. But what's important is that we're starting to see the second order effects of AI. It's not just about selling chips. It's about how individual sectors become much more financially productive. And if you look at Europe, Europe's got some fantastic leading industries. So, leaning into Europe is not just a valuation trade. It's that a lot of the companies that make the components that allow you to build big data centers, provide the technology, the semis, everything else that goes into this, actually come out of Europe. I wouldn't just focus on Europe, though, because you've got big reforms in Japan happening at the moment, the corporate governance reforms. Japan's been well known for having, relatively lazy balance sheets, and we're seeing a significant improvement in both the use of capital from the point of view of distributing capital to shareholders or selling assets and reinvesting in their own businesses. So I think there's a lot to sort of understand from a fundamental perspective outside of the US, which is starting to work and is a very good place to put capital.
Helen.
It's always the challenge of going last. I very much echo that in terms of Europe. I think, Olivia, you said right at the start, this is about where do we see earnings growth or valuations being interesting. And Europe has done very well year to date because of those two things. On the earnings side, it's been the defence story, and on the valuation side, it's been banks, which still look pretty cheap, although good earnings upgrades as well. It's not either or. And I think exactly the same for Europe this year. The banks, I think, have still got further to go. So the bank story has got further to run if you want to kind of take that as part of the valuation side. And on the earnings side, the key story, I think, for AI in 2026 is this point on energy. It needs energy to work. And that's not just about energy companies and traditional energy companies. That's any source of energy. It's energy efficiency where Europe does incredibly well, the German industrial names, and it's getting the energy to where it needs to be. So network names in the UK, we've got great networks which have done very well. You get them across the continent as well. So you've got both sides of it, growth and valuation. Just to add a little bit of disagreement, though, I don't think it's anyone but America. Actually, to Matt's point, I think it's America plus everything else. So I don't see this as an either-or story. The returns and earnings are higher in America, and that obviously gives you, therefore, higher valuations. We all know that. The other part of it, which is very difficult to understand exactly how big that premium should be, is the impact of that on the retail investor and on other investors in the market. So we've seen very much this buy the dip mentality, the support that you get from the retail investor, which is very US focused. And therefore, what we might think is an unreasonable discount for Europe, or putting it the other way, we might think is a too high premium for Europe, for the US. Actually, if the retail investors don't think that, then it doesn't really matter. So I actually don't think it's an anyone but America. I think it's very much what we've seen this year, which is incredibly strong. Over 80% of indexes this year have returned double digits. I mean, that is a phenomenal stat and very different to where we were 12 months ago. It was only about America.
I mean, I suppose one of my questions was going to be, obviously US exceptionalism. There was talk of whether it was coming to an end, then it sort of wasn't. So I guess, to your point, Helen, that it's not an either-or story, kind of how do you approach the US market, in light of that? How do you position yourself there within the context of the global positioning you'll be doing?
So we still remain either inline or overweight US in general. Not being so is a drag on portfolio, a significant underweight. Unless you get everything else perfectly right, that is still kind of at the heart of many of our global portfolios you can allocate in that way. And I do think that is likely to continue. The reason we've lost that exceptionalism exuberance was really in January, in Deep Seek Day. So you had that moment where suddenly the realization that a portfolio, that it was too overweight to the US, was not the right way to build a portfolio. A portfolio needs resilience, it needs diversification, and there are plenty of other ways. I mean, I must try and do it, maybe if I have time over Christmas. What a crazy, who has time over Christmas? To almost work out what the perfect portfolio would have looked like. You'd have started out off underweight to the US and overweight China tech. Then you would have pivoted. And then just before Liberation Day, you'd have gone all in on the... I mean, you could have built this portfolio that probably generated 300% returns if you had that wonderful thing called perfect foresight, a lump of gold in there, as we were talking about previously. But the key theme that is within that is diversification, geographically and across sectors. Best performing GICS level 1 sector year to date, utilities. I mean, it's very clear, tech is very high. There's a lot that are up there, but this idea that it's just about US tech is just simply not true. So in portfolios, to be significantly underweight the US, I think would be a relatively risky strategy. Being very overweight the US would be a very volatile strategy. So guess what? It's in between. It's building blocks and having a bit of everything.
Here to stay. So, though, I suppose in terms of that, are there really any challenges to that global dominance? I mean, obviously we talked about Europe and that being, clearly a rediscovered growth story, but is the US sort of aspect that's just the dominance is here to stay for the time being?
Well, I'm happy to start. Look, let's remember that it's been exactly the right thing to do. To have been, if you want to make one investment trade 30 years ago, it was to buy US equities, and actually to buy them in passive form, to pay the least amount possible and just be long US equities. That's spot on the trade to have made. And lots of people have done that. And it's been a structural, multi-year, multi-decade phenomena. And look, I've got a particular vantage point as we're a UK-based asset management firm. We don't have a lot of US clients. We don't have a lot of US equity exposure in terms of capabilities within our business. All I can tell you is that we have a lot of clients coming to us today talking to us about their overweights towards US equities. They're overweight US equities, and they think that's perhaps not the right place to be positioned going forward. But this has been a multi-year phenomenon that they too, if they're pension funds or their sovereign wealth funds that they too have been exposed to, it's going to take time for that to change. So look, to ring the bell and say, look, now is as I said, anything but America, it's hard to make that call now, but the starting point today is US equities are more expensive than lots of other equities. Growth trajectory is likely to be challenged from a relative perspective, and everyone's got lots of them. Typically, that's a great time to be thinking about what they haven't got lots of, and that is anything but American equities at this stage.
I think it's interesting when people talk about weightings, overweight and underweight. I mean, let's just remind ourselves, the US is 2/3 of the world stock markets, right? So whether you're overweight or underweight, you've got a lot of stock, a lot of risk. The concentration is right at the end. I mean, it can get more concentrated. I'm not saying it won't get more concentrated, but we can say with a degree of certainty, not many things about a degree of certainty over the next 5 years, but we can say it'll be less concentrated in 5 years' time. So there's almost certain to be people who are going to take profits on many of those very successful companies. They're going to take profits on the US economy and the US market generally, and they're going to go elsewhere. And the great advantage of where you go elsewhere is actually many of these markets are relatively small. The UK market is only 4% of the world, right? So just a slight change of behaviour can have a huge effect. And that's even more extreme in some of the valuations, not just of the mainstream markets, but as you move into small caps. What was interesting about last night, the last few days, is that US small caps are outperforming large caps. Now, maybe that won't last, maybe it'll reverse again, and all the rest of it. But we are looking at, when you go back to the dot-com boom, I think that's the kind of, that's the fire practice for what we're going to go through in the future. Then effectively, what happened wasn't just that, you saw, of course, a very concentration, a sort of narrow industry sector do really well. But actually, when things reversed, it wasn't so much the internet companies which succeeded, it was the companies which apply the internet well. Companies which apply AI well are going to be the ones which win. Many of them will be mainstream companies, a lot of European companies, Asian companies, but a lot of them will be small caps. A lot of small caps were surprised. Not all of them. We can all argue whether small caps are going to outperform. But specifically, the risk-reward ratio. As a fund manager, with this kind of, passive value, investing going so high, in terms of meeting companies, adding value from stock selection, I have more potential to add value now than I've had in my entire career. What a lovely starting point. Valuations are disgustingly low, and the opportunity to pick the winners is disproportionately high. Of course, I'm setting myself up for failure, but that's what I'm going for.
I've got a great phrase to line up behind that. Embedded passive risk.
Yeah.
Okay, that's exactly what you're talking about. You're talking about a market which has become so concentrated that everybody just owns it, and you've had nowhere else to go than just own it. Everyone's throwing away active management. Nobody's interested. Just buy passive, as you just said, Matt. I mean, it's spot on. But when you look forwards and you look at how equity markets have a funny way of going through cycles, over decades, they spot structural changes in the world. That's what we've seen with AI so far. But that change will not be the forefront forever. And we need to be very aware that you need to reposition yourself at a point in time through that process. None of us can sit here and call the top, but we can all sit here and look at indicators that tell us that there is something happening here parallel to the TMT bubble. probably not a bubble in valuation, which we had previously, maybe a bubble in earnings, or certainly enhanced earnings at the moment. I mean, if I go back, I was an analyst through the TMT bubble, and it actually started out with mobile phones. I mean, putting down capex to build mobile networks, mobile phones were like telepathy. I just thought of something and you knew what it was. As you went through that, people started to extend the capex that was being put into mobile phones that were generating huge returns on capital, and then starting to believe in text messaging, the internet, data. All of a sudden, we're building fibre networks with huge amounts of capex with no concept of what the return on capital was going to be. And at that point, we got to peak valuations on earnings that weren't following through. It is different this time, okay? This time, we've got huge amounts of money flowing into the cost of chips, which is creating a huge bubble or large enlargement of profitability in AI. How's that going to play out? We need to answer the question about what the return on capital is going to be from these very expensive chips and the deployment of data centers and everything else. And that's the question that we're ultimately trying to answer as analysts. And what we're saying, and what I think the panelists are saying, are that we can probably get a higher possibility of higher returns on capital, incremental returns on capital in other areas of the market. Mm-hmm. And that's how I would try and describe it.
Makes sense. I mean, obviously, just on the AI bubble, obviously, clients tell us that is the biggest question on their clients' lips. So I'm just interested to know, kind of, Helen, where do you stand on that? And are you worried about the AI capex boom?
Short answer is no. I mean, we're worried to the extent that is definitely bringing a lot of volatility into the markets. I mean, you've seen it a lot this year. In August, you just see a pullback as degrossing. We saw another one in November. And it's definitely going to be a bumpy ride as we ride it. But why, from a kind of overall perspective, do we still remain risk on and we think there is a lot further to go? I mean, firstly, it's just the level of capital that's being deployed by companies who have got a huge amount of cash to deploy. So, $500 billion, which is an enormous amount of money in being deployed by companies who only recently had to start to raise bonds in order to do that. I mean, that is quite extraordinary. The valuations are still on the profitable tech. You've got the non-profit, if you like, the frothy part, but the big cap players are not trading on crazy valuations by any stretch. And it's interesting, whenever I think about that index point, I think back to when we talked about FANGs, and then before that, and the N in FANGs was not NVIDIA, it was Netflix. I mean, it's kind of, yes, you need the kind of, where the companies that become the index, they are coming from people and the market spotting those trends. But that is what is so important, that the strength and depth of these companies is so enormous. And then the other part of this is there is a real circularity around the AI and the way that AI works. The more that AI can do, the more chips it needs. The more chips it needs, the more it can do. The more it can do, the more. And so you've got the circularity, you've got all the infrastructure that needs to be built around it. And you've also got the fact that this is relatively game-changing from a world perspective. If the Mag 7 or the hyperscalers around the Mag 7 tomorrow said, we are not spending any more in terms of capex, then governments would almost certainly have to step in. It's become much, much bigger than just the consumer and what you spend on your phone, which was really the start from the TMT perspective. This is now much bigger. So AI is a multi-year trend. We are probably just very early days within it. It's going to be a bumpy time to get there. But, there's a lot further that we need to go, both in terms of valuations and in terms of, the capacity for growth before we have to get concerned about any kind of bubble of any sort. A bubble is when the valuations get crazily high and the growth forecasts just seem unrealistic versus the amount of capital that needs to be deployed to get there.
Okay, reassuring stuff. So the next data point,
because it will be bumpy, right? Yes. It's already been bumpy this year, okay? There's been days this year that I'm sure for all four of us, it's been like, oh my goodness. It's going to be bumpy to get there, which again is why diversification is key. But long term, is that a key trend in the market? Absolutely.
Okay, fantastic. So another data point, which I think, given where we're sitting geographically and indeed the building, is really interesting. So Again, Investor Pulse research, but 87% of global investors expect more institutional flows into UK equities in 26 compared to 25. You're smiling, I can see that. So has the UK market sort of finally thrown off the relentless negativity? You know, has the government done enough to attract that capital? What do you think, Gervais?
No. You know, to be fair, the government's interested in the agenda, but really they've been very much focused with the Mansion House Compact and all the rest of it in unquoted companies rather than quoted. They just haven't worked out that actually to get the clearance in the private companies, you actually need the quoted markets to be alive. And there's been a real backlog, not just in the UK, globally, where actually the number of listed companies has actually come down rather than gone up. And so this is a major issue. You know, there has been some IPO activity, of course, the US, they've had a lot of large caps out, but generally IPO activity has been mixed all around the world. Hong Kong's had a very good year, but lots of others haven't. So coming back to it, I think the markets aren't there. I think there's a great opportunity. The whole point about a local equity market, the UK market in our case, is when it works well, it delivers not just for the investors, but actually for those who aren't savers. So specifically, what do I mean by that? Investing locally means you generate local companies and they generate local employment, skilled employment. Unemployment's going up everywhere. My biggest fear about the future isn't just about markets and all the other things, but is unemployment's going to just keep going up for all sorts of reasons. I won't talk about that now. But coming back to that, what can we do about it? We can get local companies to invest in skilled employment. Secondly, we haven't had productivity in any meaningful way in the UK for many years. Again, investment's been starved here. As you rebuild investment, you get productivity improvement, and that means that we can actually pay wages above inflation. We don't have to rely on the government to pay for our gas bills. We can do it ourselves. And then thirdly, of course, longer term, local companies succeeding pay the local exchequer. They get more. So coming back to it, actually, we've lost this whole purpose of markets, which is actually to look after the whole electorate rather than just part of the electorate. And I think that's going to be a big change. So actually, I think forthcoming governments, I think we'll get lots of nationalist politicians, UK savings for UK jobs, bring our capital back. And I think that's going to be a major trend.
Yeah, Matt. Anything about that?
Gervais is a tough taskmaster. Your question, has the government done enough? I don't know. Has it done a lot? Yes, it has. I think that's the important point that I would draw out here, is that we have seen a big sea shift in terms of focus on this as a subject, and there's been a raft of change, raft of initiatives. But again, the demise of the UK equity market has been a multi-year, multi-decade issue. So it's unrealistic, I would suggest, to see this fixed overnight. But there's lots of encouraging things. I mean, one of the most encouraging things, but multi-year payoff, is the announcement by the government just a few months ago that they're going to change the approach towards financial literacy in the classroom. It's a fundamental building block that has been woefully missing from this country. But that's going to have a payoff probably in 20 years, maybe even longer time frame. So we're not going to get excited about that today, but this is a great foundational reform that is going to make a difference over time. Look, the regulatory environment here in the UK has got a lot more balanced. The lived experience of being a listed company, running an asset management firm regulated by the FCA is different today, I would suggest, than it was many years ago. The slew of regulatory pressures that we've all faced have somewhat abated. There's a pragmatism now about the regulator. That's got to be a good thing. And then look, we start from a position of the UK is a cheap stock market. Back in that world where I would argue it's all about relativity, the UK is relatively cheap versus lots of other markets. There may be some sense of fiscal stability or responsibility from the government, or incredibility, potentially, given what we've been through the last few weeks. And here's the best thing about being a UK equity investor, is you get paid to wait today as well. Not only valuation's cheap, but you get a pretty healthy yield on your equities as well. And maybe just the very last point, again, just going back to our experience as a UK-listed asset management firm, the big UK equities business, we've got lots of clients coming to us today from outside the UK, engaging with us and talking about UK equities because they see some of these points. And having been absent for the last 10, 15, 20 years, the right thing to have done, they're now wondering whether that's something to address or redress.
Okay. So just the final data point was when investors were asked what the most significant management team action would be in 2026, it's up here, the most important actions were deemed to be effective cost controls, strategic use of capital reserves, and effective deployment of AI. So just very quickly, because we are getting very short of time, I would just love to hear from each of you what one action you want to see from management teams this year, really focusing on. Gervais?
I want them to be safe. I'm asking all my companies, I don't know what the future brings, but I do think that nationalism brings all sorts of risks which we just don't know about. So I'm asking all my companies to run inefficient balance sheets, i.e. don't buy back your shares, remain safe. If things get stuffed, then actually you can actually not just survive, but actually move into the vacated markets, buy assets from the receiver. So when you think of HSBC buying SVB UK for £1, that probably added 5 or 10 billion to their market cap, right? Nice business if you can get it. We don't know what's coming, so I'm asking all my companies to be really safe with their balance sheets.
Great. Jeremy?
I'd ask them to use our lens, which is based on return on capital. I mean, ultimately, the combination of ideas here are really talking about efficient allocation of capital. And that means running businesses efficiently and redeploying the capital at good returns. And where you can do that, you'll outperform. There's no question about it.
I say that's exactly what should be the most important. There is no doubt about it. And effective cost control should be the most important. I think in the way the market is responding at the moment, the thing that will be the most important is that third one, the deployment of AI and how that is articulated. We've seen it already in the last month, particularly in the UK, actually, with UK companies who talk about the investment that they have in AI, and they talk about it almost as a kind of cost that they have to burden, and the share price is down well into double digits. So talking about AI in a real positivity, either linking it to cost controls, linking it to revenue growth, that is what I think will be most important, even though what should be most important is always then how that actually links into the returns. I think that we have to recognise what the market is doing at the moment and recognise that, as again, it's earnings and the multiple that people are paying on things is being influenced by the narrative that companies are putting forward around AI.
But it's not a sole focus on AI. It's about
Yes.
how you deploy it, how
Correct.
you use it.
Exactly.
I mean, just look through some of the sectors at the moment. Look at healthcare as an example. I think the statistic is only 11% of drugs get through phase 3. So on a European basis, that's probably $100 billion of wasted capital. AI, through the drug companies, they believe will probably accelerate drug development by somewhere between 8 and 12 times. So is that a good investment to make? Absolutely. I mean, you'd make that tomorrow. That's got a really good return on it. But you need to use it really efficiently. You can't just spend capital because it's got a title on it.
Exactly.
You've got to understand how you're going to generate a good return from it.
Okay. Now we're nearly at time, so there's just one question I wanted to ask. This is based on the Board Value Index, which is produced by Board Intelligence, who are somewhere in the audience. Had some really interesting stats in that show that a large proportion of management teams don't think their boards add much value. And a big reason for that is they're backward looking. So, Matt, I was just keen to get your view on that.
Like I can't see who's in the room. So the CEO of a listed company, do I think my board adds value? I can generally say that I think my board do. If they don't, we should do something about that. Look, boards are there to create challenge. Boards are there to create different perspective. And if you get the right blend of skills and inputs and experiences, actually, I'm very lucky. I mean, one of the great myths I think about being a CEO, this suggestion that it's a lonely job. I just don't find that to be the case. I've got around me, at least at Jupiter, a wonderful management team who are very supportive. And I've got a great board who provide me with perspective and challenge that I wouldn't otherwise get. And I've got an ability to talk to them about, as I should do, of course, all the thorny problems that I'm dealing with. So I'm actually quite surprised by that research. Look, if that is the case, people should be doing something about it.
Yeah.
I think the point here is about board effectiveness. And we were actually having the conversation as I came in. I happened to bump into the lady whose research it was. And the interesting thing is, plenty of boards get 600-page board packs they need to read. If you sit through 3 hours of reading them out, you're doing the wrong thing. You need to work out what the 3 or 4 critical points are, and then you need to debate them, have a good challenge, and come out with the right solutions. And every business has to do that at all levels. And I think that's the key point here. So it's about board effectiveness and about getting to the key issues.
Okay. We're at time, but there was just one thing I wanted to ask you. So really, it's what one word would describe your mood when you think about equity markets heading into 26?
Well, specifically, I'm a fund manager in the UK with equity income, which delivers a return irrespective of when markets go up. Good and growing income. So I am more optimistic than I've been for 30 years.
Amazing. Matt?
That wasn't one word, by the way.
No, it wasn't.
Yeah. Sorry,
I was going to pull him up on that.
I'm going to say my one
Optimistic.
word. I'm going to say
Yeah.
relativity.
Okay.
Bullish.
Bullish. Helen?
I'm going to go risk managed. Is that 2?
That's why I'm going to hyphen. Right, we're at time. So would anyone like to ask our panel a question? Stephen. Get a mic to him, please.
Hi, it's Stephen Clapham from Behind the Balance Sheet. I feel a little bit cheated because the question was, will we see a long-term rebalancing of US and non-US equities and global portfolios? Last night, I was speaking at a conference and I said I thought the US peaked as a percentage of global capitalization last December. And there was like terrible audience reaction. They all thought I was mad. Where do you think, so US is probably 66% today. Where will it be in 5 or 10 years' time? What percentage?
Who wants to take that?
Well, the first thing to say is I think the earnings have been, its profit margins are so high already that I think there's very little opportunity for profit margins to rise. My working assumption is that labour costs are going to get much higher going forward. That's because of immigration control, but also specifically, I think we're going to get a lot more militancy where people just say, I can't afford to pay my bills, I need. So we got a general strike in Belgium last week, just to mention it, right? So particularly, I think costs are going to keep going up in terms of labour, profit margins are going to go down. My working assumption is that stock markets don't go up for another 20 years. So there's a starting point. So what the percentages are, and amongst that, I haven't answered your question, but I have given you a background.
So I'll
help.
Oh, sorry.
No, I was just going to say, I'll give you something to look up in AI. I think there's a Buffett indicator, which is market cap to GDP. And the Buffett indicator, as you almost described, is at a peak at the moment in the US. And really, you need to think about that spread of GDP globally and how it should be represented within financial markets.
I think the other thing that we should say, I mean, you've got whether the earnings or returns are going to be higher. This other impact of the retail investor and the proportion of there are a lot more retail investors in the US. Household ownership of equities is something like 45% versus about 10, I think it is in the UK. And we know that retail investors tend to favour their home country. That, I think, is the big thing that I think, so I am going to answer the question by saying I think it will be higher, because even if the earnings and returns stay around the same or converge, which I think they are going to converge, the impacts of that will push it a little bit higher. And the circularity you end up within that is going to be incredible. What we've seen this year is when you've seen pullbacks in the S&P, normally the week after, historically, before 2025, the week after a pullback in the S&P, the amount of S&P ETFs that were purchased by retail investors was lower, historically, not this year. After a pullback in the S&P, US ETF S&P purchase was higher. So retail investors are buying the dip, and the impact of that and the FOMO and then the bubble, the more you make on it, the more you invest in it. I think that means the multiple of the S&P could go higher, 25, 26, 27, and that means the proportion will be higher than it is today. So just to put something out there, don't make me put a number on it, though.
Gentleman here at the front.
My name is Richard Powell. I work for a defence science and technology company. Now, several panelists touched on defence, but we haven't really delved into it. So I'm really interested in the panel's view of the attractiveness of defence, the future of defence, particularly noting that in the list of criteria, ESG was right at the bottom, and I assume that's going down, because obviously that's been a deterrent for defence.
Who fancies that one?
I'm happy to take that. I was actually surprised that ESG was 27% still at the bottom, but it was still quite a high proportion. Defence, we still remain positive on defence, not as overweight as we had been at the start of the year, because it's had a very, very good year in terms of performance in Europe. But we still think basically the allocation of capital and the commitment from the European government as a whole, but in particular, obviously, the German government is really important for the sector. And that within that, there are, again, within Europe, we have a number of companies that actually do defence incredibly well. So across Europe, and including that the UK, we've trimmed, but trimmed because of performance being so good, and on the whole still remain overweight that sector. So yeah, still further to go, we think.
And I would argue it's not quite a sort of black and white. I think a lot of companies going forward are going to be different defence companies. We've got we're moving on from aeroplanes and ships to obviously drones. and companies which generate drones are completely different in many cases to the defence companies. Of course, they might be suppliers too, but there's, Raspberry Pi, for example, is a company which I think has done an incredible job in terms of supplying some of the drones. So from that point of view, you can get all sorts of new companies which you wouldn't normally call defence, which are going to be defence going forward.
Okay. Any other questions? Oh, Tom.
Hi, Tom Howard. I'm a communications advisor. We've heard a lot about rebalancing US to European and potentially US markets. We haven't heard a lot about Asia Pacific, the Nikkei, the Kospi. Does anyone have a perspective on which of those markets is looking attractive right now?
Jeremy?
I think I highlighted the changes in Japan in particular, similar changes in Korea from a corporate governance perspective. We're seeing much better returns on capital as a result of that. We have had pretty much the whole of the last 18 months, 2 years, have seen a huge focus on Japan in particular, and that's part of the reason why the markets run incredibly well. This is all part of the decision from a US perspective, which is where all the wealth is, where they invest in either US or non-US, and as they look towards non-US, really the extremes are emerging markets and Japan as they start to take additional risk. And I think that's why you've seen those markets actually perform much better this year or last year than other sectors.
Maybe just one thing I would add on that. One thing that we've been looking at a lot is thinking about the world of three. So when you've got geopolitical concerns, rather than East and West, you've got the kind of the world of three. So thinking about that, for example, the UAE, Latin America, these are countries and areas that we think could really benefit from nearshoring, for example, and almost just being in the right part of that world of three. So that is an area that we think is worth continuing to look at. And Japan, I would also echo, is an area, it's not an emerging market really, though, in any stretch, but certainly an area that we remain very interested in.
Okay, well, that's probably all we've got time for. So, panel, firstly, thank you. You've been utterly fantastic.